Hey everybody, Economic Ninja here. I hope you are doing great. It's really happening, guys. We're going to talk about real estate. It's almost too easy. And yes, can it change? It can, but so far, history is repeating itself just perfectly. It's just like we're back at the top of the housing bubble in 2004, 2005. It's amazing. All of those people had said, this time it's different. We don't have all those predatory loans and all those crazy NAGAM loans. Get ready. It's starting. Here we go, guys. I'm going to link the story below. We're going to talk about it. This is out of CNBC. Adjustable rate mortgage demand doubles as interest rates hit the highest since 2009. Man, you know what's crazy? You want to hear how this is different? This is how much worse it actually is. In 2004, 2005, when all these NAGAM loans came in and adjustable rate mortgages were just blowing up, the usage of them, interest rates were way higher than they are now. As a matter of fact, real estate was about at the same price, right around. It was very close. You know, sure, you get these stories, these stupid valuations in California, but come on, who wants to live there? But my point being is that real estate wasn't much cheaper back then and interest rates were that much more, which shows me that exact ratio of, you know, how much that upper 2/3 of everyone's take-home pay, that is your upper echelon, that threshold where real estate can't bump past that. All people care about is how much they can afford each month. They can't get out of their own head and think about the long term, how much they're paying for the house. That's all they care about. It's like cars too. Well, how much can I afford? That's usually the first question they ask the salesman. Oh gosh, you can't make this stuff up. This is exciting stuff. So it says adjustable rate mortgages blow up. Now, I knew adjustable rate mortgages were increasing since January. This is happening a little faster than I thought, the percentages, but this is impressive. Let's just go over the key points. First off, the average contract interest rate for a 30-year fixed mortgage with conforming loan balances, that's good credit, all of that stuff, was $647,000 or less, right? This increased to 5.37% from 5.2%, the highest rate since 2009. Now remember, in 2009, we were coming off of the Great Recession. Things were cratering, interest rates were going down. So now we're going in reverse. We're climbing the hill. 2009, it's gonna get higher, right? Because that 10-year bond rate keeps rising because you have fewer and fewer buyers of bonds, because the bond market's imploding, quite frankly, and it should be. It's in some massive bull market, right? It's really, if you think about it, it's like in a over 100-year bull market, but it's not a good thing. So people are more afraid that the market's going to implode in the near term, the next year or two. They don't want to tie their money up for 10 years. That's why rates keep going up, because there's fewer and fewer buyers. So borrowers, people that need money, need to issue debt. They have to pay a higher rate to get investors to buy their bonds, right? It's just crazy. It says the adjustable rate mortgage share of applications last week was over 9% by loan count and 17% based on dollar volume. At 9%, the ARM share was double what it was 3 months ago. Again, just like I said, in January is when these things, January, February is when things started to really pick up, because rates went from 3 to around 4% in January. That first move in December was epic. I mean, literally mortgage lending costs, right? Debt costs ran up 33% in a month. That was just awesome. I watched that and was like, ooh, we're starting, buddy. Here we go. I never thought it would hit this high that fast, right? We're literally, you're watching an inversion right now in mortgage rates that is literally at the highest and fastest I've ever seen in my career, even going back to the early 80s. This is really cool because I'm ready to start taking advantage of crashes, right? Now, with that being said, I want to give a little caveat. These crashes, they take forever. You have psychological time for people to sort of figure out things. It's like reaction time. When you know you're about to get a punch thrown at you and you go, ooh, that doesn't look good. It's slow motion, that fist is coming. I think I should do something. No, it's not going to hit me. Well, maybe I'll start to move and grrr. Oh, it hit me. But there's reaction time, right? So it's the same way in markets. People are like, hey, that house is staying on the market for a while. Hey, I'm used to those things selling like in a day. It's been like a week. Nah, it's probably got something wrong with it. 2 weeks later, that sure is a long, there really must be something wrong. They must have found a dead cat underneath. And they just did the reaction time, right? So it takes a while for these markets to turn, right? Or yeah, I haven't made 3 payments. Bank's not gonna come get my house. I mean, come on, it's like COVID time. I mean, yeah, come get my house. Like my governor said, I don't have to pay. Things like that, right? So this is a much bigger problem. Sorry, I digress, but I'm getting pumped. It says applications to refi a home loan fell 9% for the week and were 71% lower than the same week 1 year ago. Woo! You want to say layoffs coming? That is insane. And I can't, it bums me out that people get laid off. But honestly, like just as long I've been on YouTube for what, about a year and a half, warning about all this stuff coming. And a lot of people have seen it and have been really blessed and like started to position themselves, their career, maybe not take a new career, like, ugh, that stuff's, it's getting weak. We're gonna start seeing layoffs. Mortgage industry, that thing fluctuates. When it comes to employees, it can balloon up and collapse in months. It could go back up. I mean, literally anyone that works in the mortgage industry could tell you, like, it is a very liquid, very fluid kind of market when it comes to employees. And that really sucks. And that's really comes down to you picking the right career and going, you better be a business owner rather than an employee of a lender, because they'll hire and fire super quick. You know, you look at all these lenders, what is it? Wells Fargo just laid off a bunch of people. You got Better.com just laying off a bunch of people. It's really sad. So it's gonna intensify in the next 30 days. We're gonna see, I did a video about this 30 days ago. We're gonna see even more layoffs in the mortgage industry. But the fact is, and guys, take a look at the article. I'll link it below. The fact is, people cannot afford to buy a house with these crazy interest rates. So what are they doing? They're going to these adjustable rate mortgages. They have a teaser rate, right? Let's say a 3-1 ARM, it means it's fixed for 3 years, and then it goes adjustable after that. Or it's a 5-1 ARM, it's fixed for 5 years, and then it goes adjustable. Well, just like the last boom, the real estate agents, because they're the eternal cheerleaders, right? They only get paid if they get you to buy a house or they get you to sell your house. So they're gonna be the cheerleader on either side. And guys, just so you know, I am a licensed real estate agent. I had 2 brokerages. Not even the place I worked at as a real estate agent knew that I owned 2 brokerages, but that's okay. I like to live like that. I truly do live like a ninja usually, unless they're watching this now and awkward. Point being is this, we turn around and you wanna be an eternal salesman, right? But the facts are, now they're telling, well, you're getting priced out of the market. You better do it now. You're gonna have to jump. You know, this time it is different. No, it's really not. And interest rates are up. Well, why don't you get an adjustable rate mortgage? Interest rates have went up so high. The likelihood, now think about this, the likelihood of rates being higher when it goes to adjust 3 years or 5 years from now is darn near impossible. Look at what interest rates have been for the last like 20 years on average. It's not a good argument, guys. That's going to come back to bite some people. It really is. Because historically, rates sit in a healthy market anywhere between mortgage rates, between 7.5% and 10%, 11%. That's a healthy market, because that means that people are gaining interest in their savings account. Now, I get it. Those rates haven't been around since 2000. Right? Those higher rates. The first time I ever bought a mortgage was 7.25% for a personal residence, and then I bought my first rental about 60 days later, and I went crazy after that. And I paid 8% for my first mortgage on a rental, and I didn't lie and say it was a owner occupied. I was like, it's a legit rental property, so I was paying a higher rate than my mortgage, and but at that I was cash flowing. I was cash on cash was incredible. It was literally like in the 25%. It was great. Those are great days. And that was with minimum down. That was with, I think I want to say on the first rental, I put down 10%, and that was just a normal loan. So that is a normal, healthy market, and we are going to revert to that. But I believe it's going to be way worse. The bell curve is going to swing the opposite direction, and it's going to revert. It's going to overreact because our currency is collapsing. And that is evident with all this interest rate. So I want to bring this story to you because it's super exciting. For so many of you guys, you're on the sidelines. And I know there's going to be someone who goes, well, Ninja, you're talking about buying a house. I'm like, oh, I'm in a different position than most people in this world, to be honest with you. And again, I wouldn't come before you talking about all this stuff, financial, if I didn't have a background in finance, but it's not financial advice. I'm not a financial advisor. I'm just a dude that made money, right? By trying many different things. But yeah, I'm still looking to buying a piece of land to start a little farm, and then I get lots of write-offs. To me, a write-off is putting money in my pocket, putting a lot of money in my pocket. And we'll start doing some videos about that pretty soon. All right, guys, there's a story. Adjustable rate mortgages are blowing up, and get ready because there's gonna be, if this continues on for another 4 months, 5 months, I'm gonna predict something. Put this in your notes. We're gonna go back to negative amortization. Because they've already forgotten, guys, trust me. Just all of us that got our YouTube economy degrees on YouTube know about it. All right, guys, that being said, I thank you so much for watching. The Economic Ninja is out.